Hello, everybody. My name is Gavin, and I would like to welcome you to GCRE TV, the new home of commercial real estate. Today, we're going to be speaking with Michael Bull, who is one of the well-known celebrities in the industry today from Bull Realty, and we're going to get his thoughts on COVID-19, the impact it's been having on his business as a broker, but also in the industry overall. And hopefully, we'll have Greg Dickerson join us on the show today. So I would like to welcome Michael. How are you doing today?
Good. Excellent today, Gavin. Thanks for having me on.
Yes, it's a pleasure to have you today. I just introduced you. This is Michael Bull, founder of Bull Realty. He's also a very well-known celebrity in the space, as we like to say. He gives George Clooney a run for his money sometimes. So, Michael, today we just want to talk a little bit about the impacts of COVID, what it's had on your business, on your clients or friends' businesses. What you see happening in the industry, kind of what's going forward, what are your thoughts on it, and then basically some pointers as well for the viewers on anything that they might find interesting or you might want to share with them to consider when going forward.
Sure.
So the table is yours. How has COVID been treating you and your business today?
Well, it's interesting. It's obviously slowed everything down. A lot of people working from home. We're headquartered in Atlanta, Georgia, in the Southeast U.S., and we're a regional firm and do business all over the U.S., especially in the Southeast U.S. And so I think COVID's affecting different sectors, property types differently. And it's interesting. So obviously look at hospitality. It's really hurt hospitality in a big way. And our hospitality team is busy working on notes and short sales and workouts and selling distressed hotels. And some people are getting some real good bargains on hotels right now in the acquisition side. On the retail side, we're seeing some properties are still doing well. And then some properties are just really hurting with some of the retailers not being able to open or just not doing very well. So the retail sector has obviously been hit pretty hard. I think the next sector to consider is office. And the office market has done fairly well through COVID. However, there's some of the larger cities where the people aren't back, the employees aren't back in the buildings. So obviously that worries building owners and lenders and buyers of office properties. So I think we're going to see a time here where people feel like they can be productive working from home. And there's a lot of big companies, GE one of them, that's found that tried that in the past and it hasn't worked. So I think what we'll see is as the pandemic lessons and there are more people starting to come back at work, and then some companies have still work from home policies, they're going to suffer in productivity and quality. Those companies are going to suffer in onboarding and retention. And it's like you learn from the people that have been in the business around you, younger people, older people, and to not have that benefit is going to hurt a lot of companies. So I think you'll see office kind of out of vogue for 12, 18 months, and then I think you'll start seeing it coming back. And then we also sell medical office buildings and government leased office buildings, and those two sectors have been strong. We've still been very active selling those types of buildings, so we haven't seen a slowdown there. Industrial real estate's, for the most part, really benefited from COVID, with the online sales really picking up, and so that sector is really doing well. Rents are doing well. Occupancy is doing well. It's hard to find properties to buy in the industrial world. So that sector's done really well.
Okay, good. And so if I hear what you're saying is, some parts of it is actually slowing down right now. Some parts of it is actually getting better. I know yesterday we had a call with a guy who's in mobile home parks and he's absolutely busy. We had a guy as well that runs a national finance brokerage, and he said it was extremely busy. What do you see on your side? Do you see a lot of moves being made on the financial side? People looking for funding? Is funding still available? Stuff like that?
Yeah, there's a lot of dry powder. There's a lot of capital out there. Some of the lenders are being more conservative, which they should be, and looking at deals harder. They're more interested in sponsors that they've had good experience with borrowers that they've dealt with before. They're looking for a little more equity, but interest rates are low. There's a lot of capital in the market. So funding's out there if you're a good sponsor and have a good project. So that really hasn't slowed down. Just on the brokerage side, that tends to, the level of activity there a lot of times depends on the brokers. It's interesting. I can see some of my brokers that are just really busy, really active, doing a lot of transactions.
Yeah.
And some other brokers who are not. And it's a lot of that's in their head. Hey, things aren't going on. Things are bad. I'm not going to make calls. I'm not going to get out there and get busy. So a lot of our brokers are very busy, and some of them are slower.
Okay. Well, guys, Greg just joined us on the call. Greg Dickerson is a well-known celebrity as well, like yourself, Michael. We thought we'd introduce him to the call today. We should have a really good discussion going on about COVID and the impact and what two people are seeing it from different ends of the spectrum. Greg, welcome. Thanks for joining us on the call. I know it was a bit last minute, so we appreciate it, you joining us.
International time zone stuff.
I know, right? Switzerland, Atlanta, Georgia, New Zealand, everywhere we are. So it's one of those things. Michael, I want to introduce you to Greg. He's one of our mentor and advisors, as you know, but also an industry expert like yourself.
Hello, Greg. So, good to meet you.
Yeah, good to meet you, Michael. Yeah, so I was listening to you talk there at the end. You're in Atlanta, right?
Right.
Yeah, so so that discussion, was that for sales or leasing? What were you referencing in terms of the brokers that you were just discussing?
Our leasing brokers are fairly busy. And some of it is helping tenants downsize or sublease. There's still active tenants, especially on the medical side, that are opening and moving up. But mainly speaking on the sales side, we're mainly sales brokers. 90% of our practice around the Southeast U.S. is based on investment sales.
Yeah, just all types.
Yeah, we have 30 brokers, and they each are on different teams. Focused on their sector. So be it hospitality, medical, office, we have a senior housing group. I lead office sales group. We concentrate on large office buildings in the U.S. So we have a retail division, a single tenant net lease division, and they're all affected a little differently.
Oh yeah, that's interesting. Yeah, so the leasing brokers are busy. What sector are you seeing the activity there?
Medical office is still fairly busy. That's fairly active for us.
Really?
We also doing some retail leasing, which surprised me. We worked on 3 leases yesterday in the retail world. I'm glad to see that.
Yeah. What type of users?
One was a hair salon. One was a restaurant, believe it or not. And then several different types of medical leases.
That's interesting. Yeah. So I've been talking a lot about repurposing space. And so were these spaces already, turnkey, upfitted, ready to take over from a pre-existing business that went out?
Some of them were, and some of the medical office not. They're going to need some build out.
Yeah. But the hair salon and the restaurant, that's the one thing that I've been telling a lot of people. There's going to be some opportunities to walk in and just take over those spaces for businesses that unfortunately couldn't survive COVID.
Absolutely. I think there's going to be a wave of businesses that shut down and new ones that open.
So what's the appetite from your landlord clients in terms of TI?
It depends on the tenant and their use and what they think about their business. I think they're all looking at things a little differently, but I think the office tenants, the office landlords are just eager for tenants right now. So they're fairly open to, if it's a credit tenant, they'll supply the TI.
Yeah, that's an interesting conversation. Gavin and I were talking about that earlier today. That is one of the most affected spaces, and the real question is going to be: we know that people are going to need more space, more square foot per person in office.
Yeah.
So what is that going to look like in terms of, the user? Hey, I need more space because I need more space per person, but I can't afford the expense of the additional space.
Yeah. Well, I think there's going to be various outcomes from it. Some companies that just can't afford it and need less space is one thing. But I think the other thing is, as this work from home glamour wears off and companies see the issues of it with productivity, right, with retention, with recruiting. How would you like to be offering a position to a great young employee? So you're going to love our people. You're going to love our culture. By the way, you're going to be at home by yourself.
Yes. I think we see that happening a lot today, right now.
Yeah.
It's interesting. And, I think different companies are finding different answers to that question. Some of them are finding more productivity with remote working and, obviously a bigger pool to choose from without having to relocate. And then others are finding that they're not as productive and, it's difficult to maintain that culture remote and, through, Zoom and other medium.
Yeah, and you're right. I think it varies for the business and what they do. And there's so many businesses that really benefit from being around each other. So I think there's going to be a lull in office demand for a year or 18 months. And then I think it'll really start picking up. So what it could mean for if you're an institutional office investor or smaller offices, that you might get some deals in the next year or so. And that because occupancy may be lower. And then I think those buildings start filling back up.
Yeah. And it's interesting too, with the different cities, so Atlanta hasn't been on the map or the radar or in the news, but when you look at Portland, Seattle, New York, Chicago, and, I saw a report today, New York's got 15,000 vacant apartments. And then, office space is just, they can't give it away up there right now.
Yeah, I mean, it's incredible. We have a lot of clients in New York, and it's Desolation Boulevard up there. I mean, it's terrible. And but I think it's a lull that soon as people feel more comfortable that there's a vaccine and that this COVID thing is rolling out, people will feel more comfortable. And New York's a vibrant place. We've all been there. It's crazy exciting. If you're really good at what you do, you probably want to be there. So I think New York will come back strong, and people will want to be there again. You think about people said after 9/11, no one was going to office in high-rise office buildings again. They did. New York will come back.
Yeah. And there's, I mean, that's huge. 8 million people and just all of the, space and businesses and companies in that market. I mean, what's going on now is not enough to make a serious long-term dent in population, growth or things. But in terms of inventory, with Hudson Yards and, other projects like that, the World Trade Center sites coming online, things like that. I mean, there is a tremendous amount of office space to work through over the next few years. But in terms of population, I don't see any of the major cities, significantly impacted by people that are moving out, like LA and Seattle, Portland, those areas. You might get 100,000 here, a couple 100,000 there. You might get 500,000, but these cities are huge. That's not enough to really do any kind of significant long-term damage to, the local economy and growth overall. But Atlanta's interesting. Are you seeing an influx, from some of the other cities into the Atlanta market?
Well, even before COVID, we saw a lot of investors out of New York and cities like that selling properties and doing 1031 exchanges, moving down to the Southeast, to the Sun Belt, and buying properties in this market. So, Atlanta was one of the first ones to open up, and we don't rely as much on transit as some of the larger cities. So, we're a real car-oriented city. So you can get in a car by yourself and come to your office. So I think we'll rebound fairly quickly here. And the economy in Atlanta is very diverse. The airport is already getting much busier. So yeah, Atlanta's doing fine. I think it's one of those cities that will rebound rather quickly.
Yeah, one of the biggest little cities in America.
Right.
Yes, definitely. And Michael and Greg, just a quick one. Like, of course, with everything that's going on right now, people are panicking. People are wondering, what to do. What advice would you guys have for somebody in that position right now, who's probably relatively new to investing in the commercial real estate world, or have recently just invested and thinking, "Oh my God, is this doomsday?" Like, what's your guys' opinion on that? Like, what would be your advice for them?
Go ahead, Michael.
Well, I think it depends on the type of investor and what they're investing in. And if they're a small investor, they're investing maybe in some single tenant net lease dollar store type properties. It can still be a great time to get into some of those businesses, those tenants that are doing well and have traditionally done well and are very high credit, to take advantage of these low interest rates and invest in some of those single tenant net lease properties. As far as investing in opportunity zones and projects that are in opportunity zones. There's still some time to get in some of those projects. And, that's an amazing program. One of the benefits is if you hold the property 10 years, you don't pay taxes on the gain that attributed to those 10 years. So that can be pretty big. So there's a lot of opportunities in real estate, commercial real estate investing right now. I think you always want to look very carefully at the tenant mix, the area, compare the rents to the peer properties. Really have someone that knows the market well to consult with you and get out there and invest. Real estate's always been traditionally a strong investment and will continue to be.
Well, I think opportunity zones are something that's kind of a big hot topic right now. I've been seeing and reading a lot about, considering I'm still relatively new to the industry and getting more and more knowledgeable into it. But I noticed that I think with a lot of buildings going to be empty, especially retail space on high streets, especially, is going to be a huge opportunity for opportunity zone projects happening there. Greg,
that's a good point. And Greg, as you know, a lot of investors really follow the cycles.
Yeah,
I remember calling some of my clients that I deal with a lot in really good times and offering them a property, and they'll chuckle and laugh and say, "Michael, it's a great property, but I don't buy when times are this good. Call me when there's a recession. Call me when there's a problem. I'll be buying then." So, there's a lot of capital out there. There's a lot of strong lenders. So there's going to be a lot of acquisition opportunities and a lot of sales. I don't know if the prices will be as low as some of the opportunistic buyers would like to see, but there will be opportunities.
And that's me. So I'm opportunistic. I'm a developer first and foremost, as well as an investor. So I'm a margin player. So there's two types of investors out there. You have investors looking for yield. They're looking for a storehouse, a warehouse for capital. And then you have people like me who are opportunistic, and we're looking for margin. We're looking for big gains. So, I'm in that latter sector, and I was heavy in 2009, when that all went down, and I had a significant holding at that point, and I was developing a lot of property. So it's a very interesting mindset between the two, whether you're looking for yield or whether you're looking for margin. So first and foremost, for somebody like me who's spent 23 years building what I've built and accomplishing what I've accomplished, my first and foremost and most sophisticated investors that I deal with and that I'm coaching in terms of my clients are after, number one, preservation of capital. So we don't want to lose what we've spent our lifetime building. So that's the first thing we're thinking when we look at a deal, whether it's a yield play or if it's a margin play. So we're following the macroeconomic environment as well as the microeconomic environment at the local level, like you'd mentioned, on the different asset types and markets and uses and things like that before we make a move. And you can't, nobody knows the future, but we do know we're at the top, and it's more important to call the top than it is to call the bottom. That's the most important thing to know as an investor, whether you're opportunistic or you're looking for yield, you need to know the top. And then you need to hedge that in terms of calculating your risk, and you need to be able to calculate the risk financially in terms of the loss that could be realized if the deal doesn't go as per plan, and your thesis is off in terms of your investment, criteria. So when I look at a deal and I look at an investment, and I'm asset type agnostic and I'm market agnostic, I look at the deal. And it doesn't matter what it is, where it is, the deal is what I look at first and foremost. And then I've got multiple exits, and then I've calculated the downside if nothing works. So from an opportunistic standpoint, that's kind of what I'm after. And what's interesting is, so you look at opportunity zones. Those are interesting, but they haven't gained momentum yet. And when one of the issues with opportunity zones was the investment that you had to make, in terms of that improvement test, right? So you had to meet an improvement test for an opportunity zone real estate asset to apply and to be able to qualify, meaning you had to improve the property to more than 50% of its value. So that was very difficult for a lot of investors to get their mind around, because you couldn't just do a value add or a core plus deal. You had to have an opportunistic deal. And a lot of investors aren't opportunistic bent. So that was only playing into the hands of developers. The original intent of the opportunity zone law was to incur and spur business and economic development. So they wanted business investment. And then they had some restrictions around that they had to change that were kind of actually, limiting the amount of investment you can make in a business, because your sales had to come from the direct region. So if you were an e-commerce player, you couldn't, set up shop in an opportunity zone and take advantage of that. But from a real estate standpoint now, to Gavin's point, there are now going to be a lot of adaptive reuse plays where these office buildings, hotels, senior living facilities. I'm working on one right now, a senior living facility that closed down due to COVID, and it's empty, and they're selling it off because they just don't even want to deal with it. So we're going to turn that into a multifamily property. So that now will qualify in an opportunity zone for an investment because, of the substantial improvement test that has to be met for that. So those are things you got to look at. But, to your point in terms of the overall pay down, you get a write down at 7 years, you get a write down at 10 years. The gain doesn't go away. It gets written down 7 and 10%, 7 to 10 years, or 15 to 20. I can't remember what it is, 7 and 10 years. And then the big payoff is after 10 years, anything that you've earned on that investment is tax free. So that's what escapes the gain. Your original investment is still taxable. It just gets written down after a 7 and a 10 year hold period. But nobody knows the real test in terms of how the IRS is really going to measure these things and what the real impact of that opportunity zone legislation is going to be. So there was a lot of excitement initially, but it's lost a lot of momentum. And we're seeing some deals get done, but it didn't do what they hoped it would do, which was to spur business development. It didn't do that at all. It mainly has been used as a real estate play, and it's been very limited. A couple of hotels taking advantage of it, maybe a couple of industrial properties, things like that. But it's been very slow, and I don't think it's going to gain any legs moving forward because it is such a long-term play. And the guidance from the Treasury is still, or Department of Labor is still uncertain in terms of how different investments are going to be treated. If you recycle the capital, if you refinance, if you sell, reinvest that gain, all those types of things. So there's still a lot of questions, and it hasn't been tested yet with the IRS and with the rulings from the Department of Labor in terms of the ultimate impacts of those investments.
Yeah.
Thanks a lot for that, Greg. That's some really good points.
Yeah, very good points. And back to your opportunistic type of investments that you do, you're dealing in a larger property type, sophisticated investors like a lot of our clients. But there's also some people out there that are smaller investors. And one of the things that I've mentioned to some of them to think about investing in real estate in this way. If you're at a cocktail party and everyone's talking about how great real estate is and how much money they made flipping this contract or buying this condo or whatever, you should be selling. And if you're at a cocktail party and people are talking about how bad real estate is, how terrible it is, you should be buying.
Yeah. And, so the important thing, so for the smaller investors, maybe they're just getting started or, they're just at a smaller level. People always ask me, well, what's a good deal? Mm-hmm. So you need to understand first and foremost, what's your goal? Are you looking for yield? Are you looking for margin? Are you looking for long-term hold where value doesn't matter because the price you pay is permanent. The financing is what's temporary. Okay. Mm-hmm. So you can pay anything you want if you have the right financing and it meets your return requirements. So number one, what are you looking for in a return? Do you want 5%, 7%, 10%? That's first and foremost. You can pay anything you want or any price if it meets your return requirements. And that's going to be based on the financing and how much money you put down, the equity that you bring to the table. So that opens up opportunities for a lot of people that aren't thinking that way. Like a lot of people are thinking, well, I want this thing to appreciate and be worth, tenfold what I paid for it now in 10 years or 20 years. We don't know that that's going to happen. But what we do know is that the financing can be structured in a way, and the equity that you bring to the table has a measurable return over a certain period of time. So what's your cash on cash and what's your internal rate of return that you expect from the deal? And if you go into your investments and you look at properties or any investment that way, that opens up a lot more opportunities for you. So for me, I'm a 30% guy, so whatever I go into, I'm looking for that kind of a return. And the only way to get that is opportunistic from a distressed asset or, ground up adaptive reuse type of a play. That's the only place you're going to get those kind of margins. And even that's very difficult right now. So I'm comfortable sitting on the sidelines and waiting because I can do some other things to, earn, while I'm waiting for those opportunities to come along. So that's something to think about. It's, decide what it is you're looking for and then go shopping, in terms of a return.
Sure. And I like your points there and your risk tolerance. Some people are looking for 6-7% return, and maybe they don't like much risk, and they can find that. You're looking for in the teens and higher. Maybe you're looking at a little more risk. And I like your point about the principal reduction over time. I've got some properties. I used to buy a property just once a year as a young man, and just hold on to them, not refinance them, not sell them. And I know it's a very, very conservative way to invest in real estate, but I'm also a real estate broker, so I'm in real estate already. So to diversify, I had some conservative investments, but it's nice now to look at the principal reduction that I'm getting on those loans at this point. So to your point, even if I don't have a lot of cash flow, which I do on those, but if you don't have cash flow, that principal reduction every month that I see, I'm like, okay, I'm saving some money, or I'm adding to my net worth. So yeah, there's a lot of benefits in many areas of investing in real estate. And I think this is the time to not be afraid of it, but just be careful.
Oh, the money's free right now. So yeah, I mean, anybody who should be refining their portfolio. And then what that does is, I mean, you can get sub 3% rates right now, for commercial debt, which has been unheard of. So you could refi now and, pull equity out if you want or not, but then take the excess that you were paying and continue to pay that principal down. So you can still maintain the same payment, just pay more principal down quicker, which reduces your overall cost of that asset. So you don't need appreciation anymore like we used to. Back when rates were a little bit higher, prices were a little bit lower, and you had more appreciation, and a lot of the deals that were being done were for that. The game has kind of changed now because we are at the top. So the question is, what's your cash on cash return? What's the internal rate of return you're looking for? What's the time value of that money that you're looking for? And forget about appreciation. You're generating some cash flow, hopefully. You're getting a return on your cash that you've invested, and then your principal's getting paid down. So you have an equity build along the way. And I mean, the money's free right now. So, it's a very interesting time in real estate.
Yeah. So guys, we're coming up close to wrapping up our time. In fact, we've run over a little bit today. I guess the conversation was really interesting. I certainly learned a few things from it. What is a couple of pointers for people to take away from this today going forward? As COVID still goes on, seems to be another wave, they say, is coming. We have it here in Europe right now, where Switzerland is shutting down. I know Italy shut down recently. Spain, Denmark, I was supposed to go to, got shut down as well. Everybody's kind of like, when is this going to end? Like, what would be your advice going forward for people? Just as we close off the show today.
Michael, go ahead.
I think when you talk about COVID itself, I think a lot of people have different opinions about it and the impact on everyone. I can tell you personally, I contracted COVID in July, and I'm an old guy. I don't have any pre-existing conditions, but for me, it was 10 days of just being very tired. I actually worked from home. I obviously didn't go to the office. And I worked from home. So, I think when we talk about the young people in the schools and things, I just hope it's not a little overhyped, the danger there, because I think the danger of shutting down the economy in such a big way and to have more devastating impacts on people's health long term. So, I'm hoping that we get a vaccine, we get through this as quickly as we can at this point. And the people that I know personally that have contracted COVID have had similar experiences to me. It was fairly mild. So I'm not saying that it's not a dangerous pandemic here. It is. But I'm just hoping we can open up the economy as much as possible in safe ways, and that we're not shutting down entire cities and things when that's not overall long-term health-wise a good move.
Yeah, I totally agree with you. Greg?
Yeah, so I think, in order for people to mentally get over the hurdle, wherever people sit on the spectrum of what's going on, you need a vaccine, but more importantly, you need treatment. So you need to take death off the table, and you need to take ventilator off the table. So people need to know, even if I do get it, like Michael's experience, I'm going to feel bad for a little bit. It's going to be like the flu. I'm not going to end up on a ventilator, and I'm not going to die. So people need to know that for certain before we can 100% move on. Because there are going to be people that just are just not going to get out and are not going to do life as normal until they know those two things. So vaccine is one thing, and a lot of people aren't going to take the vaccine, especially with reports of negative side effects, even though every drug you take has potential side effects. people are very leery of what's going on because of the election cycle and all the politicization, if that's a word, of everything that's going on. So that's number one. Got to take death off the table. Got to take ventilator off the table, whether you have a vaccine or not. Those two things have to go away for the economy to recover and move on. So from the two pools of investments, if know thyself. So first and foremost, know what it is you're looking for in terms of your return. And if you're a long-term investor, principal reduction, cash on cash return, internal rate of return, you're fine. Go shopping, call Michael, and go buy stuff because there's never been a better time. Now is the time. Doesn't matter what you pay. The financing is what the key to that is, and your return requirements. So you can pay whatever you want. You can buy whatever you want if you're long-term. If you're opportunistic like me, you need to be cautious and you need to be very careful. And on the long-term play, you need to understand the cost of operating in a COVID environment because it is more expensive to operate your assets. Taxes are going to go up, insurances are going to go up, and your operating costs are going to go up, period. So you need to understand that and add that to the equation on your long-term hold. Opportunistic, you need to be very careful what you do and where. You need to understand the political environment. You need to understand there's an election right now. We don't know the outcome of that. We don't know the outcome and effects of COVID. Hopefully it's not as severe as we hope and think, but it could turn into, tenfold of what it is now. We don't know. Yeah. So, so you have to be very cognizant of that and careful of that as you move through. But the other thing that you need to know about being opportunistic is when you're working in an environment like this and you have debt and you've taken a loan, those guys, the lenders are your best friends. They're going to work with you through this environment. So that's the one thing I'm sure Michael can vouch as well. Know thy lender, know thyself, and know thy environment before you make an investment. But everybody's kind of working together to get through this thing, but you got to be smart about what you're doing. You have to calculate the risk down to the dollar and make sure that if whatever you're thinking doesn't work, you can withstand that hit. That's the key. That's how you make it through 2009 and 10. That's how you make it through whatever is coming the rest of this year and into next year. But for me, I'm fine being patient and waiting out the election and COVID, just kind of, see what's happening. But like that senior living facility, the right deal comes along, you got to jump on it.
Good advice.
Good advice. Okay, guys, it was a pleasure to have you all on the show today. We appreciate it as always. Michael, we look forward to doing some more shows with you. Greg, as always, a pleasure to speak to you. And I'll speak to you guys soon. Take care.
Take care. Good to meet you, Michael.
You too. Cheers,
guys.
Thank
Bye.
you.